Yes, thank you. Thank you for your advice. Now, moving on to the markets. Personally, I think this is the most confusing bull market anyone has ever seen. But then again, maybe what we have seen in the past doesn't always work the same way it does going forward. Maybe not all hiking cycles are created equal. Could you tell us some of the differences in the past hiking cycles, say 2018 versus 2022, 2023, and how they impacted the risk assets? And what will this all mean in the second half of 2023 and going forward 2024?
Those are very relevant, very important questions, and I agree with your initial statement that I think this is a very confusing market for a lot of market participants. I think that coming into this year, few, if any, people would have predicted that S&P is up nearly 20%, very close to all-time highs again. That some of the tech names would have performed, even far superior to that in looking at some of these profiles. To your point, the hiking cycle that we're in is very unusual. The Fed has now hiked 500 basis points over the course of the last 15 months, which makes it the largest hiking cycle that we've seen for some 30 years, which by itself makes things quite unusual. And the speed at which that has happened has almost been unprecedented. This has been a very compact hiking cycle, over that duration of time. I think what has really confused people is when you see a monetary tightening of that magnitude with that degree of speed, you would have expected a much larger impact on the real economy. And some of what I think people have missed or what they've struggled with is, number one, just the size, the overall magnitude of the fiscal stimulus that we had injected into the system coming into this, because obviously it was the largest fiscal injection that we've ever seen. What we saw during COVID. And not only that, but the U.S., for example, is still running somewhere between a 6.5% and 7% federal spending deficit. So we are still providing quite a bit of stimulus to this economy. We are essentially in doing wartime spending now, but without being in a global conflict. And I think that balance has also dampened the impact that monetary policy typically would have had into a 500 basis point type of hiking cycle. And there's a third bit of this, which I think is also fascinating, but I think something that will ultimately prolong this cycle is the way that Chairman Powell has managed this over the course of the last 15 months is he has allowed financial conditions to tighten very dramatically, and then we'll see something like the regional banks break. But then he's also been willing to allow financial conditions to ease, which is what is happening now. And obviously in the post-regional banking crisis, there was another injection of liquidity into the market. So we essentially adopted a hybrid QE type of phase to this monetary tightening cycle. So at the end of the day, you have a lot of conflicting signals. You still have a very large fiscal impetus. You have a 500 basis point tightening cycle, but we're still incenting consumers to spend and support the markets, which obviously all of this also points to the very tight labor market that we've had. But I do think that what we are in for now is an extension of what would be a typical cycle because of this movement of the financial conditions and the easing and tightening that they have respectfully gone through. But my own base case is that a soft landing scenario, which is largely priced by the markets, is a very incredibly difficult thing to manage to, and we will end up into a deeper recession sometime probably late next year.
Are we then headed to stagflation?
Well, I think what is fascinating about this, inflation is still, notwithstanding the fact that people are more comfortable with levels, is still running very hot to the Fed's target rate. And I think one of the surprises that we will have, what will make this hiking cycle more like what we saw in the 70s than any of the more recent hiking cycles. And if you remember, back in 2018, 2019, Chairman Powell, his mid-cycle adjustment was to slow down the pace of hiking. I think in this cycle, you're more likely to see a resumption of the hiking cycle. So you will see that inflation will end up being more persistent than central banks are comfortable with. You will see additional hikes need to be priced by the market and implemented by the Fed over the course of the next 6 to 9 months. But I think you're going to see a mid-cycle adjustment that is the exact opposite of what we saw, over the last couple of cycles, which ended up giving a boost to risk assets and equities. And in this case, I think those asset classes may end up being more challenged.
Are there or where are the tail risks in the market? Where do you see the unpriced tail risks?
Well, look, I think the unpriced tail right now is back to all-time highs. It's this melt up in risk, which quite frankly, I don't think a lot of people are positioned for that. They haven't been positioned for that. They have missed this rally. So that is what I would describe as a more positive tail event, because it involves markets going higher and not lower. But that is probably the thing that we are all faced with, first and foremost. From the other side, from a more negative perspective, because of what I mentioned, in that this is a period where the Fed is allowed financial conditions to run both hot and cold. I do think that there will be a period where they need to tighten financial conditions again because of the persistence of inflation. And I think, like with the regional bank situation in the U.S., you will see other things that need to break, because there continues to be a lot of speculative pools of leverage in the markets. I think that while the Fed has been successful in popping some of the bubbles that have existed, asset pricing is still rich to fair right now, and I think that there is more to go on that front. And look, from a longer term perspective, these are not necessarily actionable today from a markets perspective, but I think the resolution of Russia-Ukraine, whether there's a successor to certain world leaders like a Putin, who steps into those vacuums, I think things like that are just going to be fascinating to watch over time. But I think that because of the divisiveness and with the rise of populism, with more divisive politics in the U.S. in particular, I think this is a fascinating period, both politically and economically, and I think that that's going to present a more volatile overall backdrop to markets than certainly what we saw in the post-2008 period, where you had volatility being suppressed by QE and in what the global central banks were doing. I just don't think they'll be able to engage in those vol suppressing techniques, nearly as much as they have in the past.
Okay, so just to recap, I think you mentioned in the more longer term, you expect a few breaks here and there in the markets. Asset pricing needs to come down a little. What about any short-term recessions? Clearly, the equity markets right now completely deviating away from this path, or
no, it always matters. I think, look, the labor market is the key to that. The labor market, at least in the United States, is just too strong right now to allow us to tip into recession. So I don't see us moving into recession on any imminent basis. But I do think that is a more intermediate to longer term problem for the Fed, because at some point in this cycle, the Fed is going to have to take the neutral rate to a point that breaks the strength of the labor market, and that's when you're more likely to see a recession.
Okay, so the last item on the macro investing side, cash. Cash is now an investable asset again. Do you think investors will demand a higher hurdle rate?
Yeah, absolutely. I'm just looking at my screens here as you mentioned that, and look, you can buy a 4-week Treasury bill that earns 5.25%. Like when that becomes an option in its own right, certainly a lot of assets will be attracted to that. And for firms like my own or other possible investment options, you need to provide a risk-adjusted rate of return that certainly is superior to the risk-free rate. So in periods like this, I think that when cash becomes an alternative in its own right, that becomes more competition for all of what we do, and it forces a higher return profile for investors to be compensated for the risk that they're taking.
Okay, so thank you so much for sharing your market perspectives. Moving on to our next topic, which is AI. We can't not talk about AI these days. I actually remember a line from your book. I actually wrote it down here. It says, I feel like I'm part of the wave that's being replaced by computers, machines, death of a salesman, macro style. Well, I feel like now is that time more than ever, in a very literal sense, as we're entering this new hype cycle led by the generative AI. I'd love to hear your thoughts on the recent AI boom that seemed to have swept the entire capital markets. Is this a bubble, and how do you detect a bubble? And is it, or maybe it's a good idea to ride the bubble?
Well, look, this set of technologies is certainly transformative in a lot of ways. At the end of the day, you're embedding, 1,000 years of human knowledge that you can access in seconds. It's incredible. It's as if I could learn everything that a human being has ever learned, and know that, and know how to process that information. So that by itself is just such a significant step forward, which will impact most industries, investing included. I do think that it is early though in terms of understanding who the winners are, who the losers are, how will this technology be harnessed over time, et cetera. So we can certainly talk a lot more about this, but I don't think just because a management team on a corporate earnings call says machine learning or AI or ChatGPT, should really mean that they deserve a higher multiple on their stock. I think that that there's a lot of detail in terms of the manner in which they will harness that technology. Does that mean that they will do better on the expense side of the equation because they think that they can use this to run a more efficient business? Can they truly harness this on the revenue side to generate more incremental revenues? I think that there's a lot to be gleaned from this over time. So it's very early stages. I think some of these companies will certainly be winners who have profited so far, but I do think that the next wave of this is that investors will become a lot more discerning and demanding details for exactly what this means, as opposed to management teams just kind of using and throwing out buzzwords to try to get a good response.
On the equity side, though, are the current multiples going to be re-rated? Is this a new level that a market needs to adapt for embracing this new technology?
No, look, for now it is a new level, but I think that I think it will be very difficult to move much beyond this until investors are given more concrete guidance in terms of what this actually means. Look, I think that the real kind of gem in all of this is putting different types of models together. And to use the investing world as an example right now, the language models, so while they've gotten much better, they are still prone to mistakes, to hallucinations, and while they perform at a very high level in terms of knowledge and memory, they still make mistakes because of the way that they are programmed. And I think that the real where this will come together is, over time, you will need to incorporate different types of models, language models with statistical models, and what ways to be able to teach more the machines more in terms of intuition so that they can suggest trade ideas or trade generation themselves. Obviously, from a short-term trading perspective is where they are, most easily deployed now because there's a lot of data, and with those data points, you can predict the next data point and the next movement. But to use macro investing as an example, I think that these machines don't yet have the intuition to understand when the regime is shifting and when we're more likely to head into a recession, or to be able to guess how changes in monetary policy may impact current market conditions. And, I think we are all aware of this story, but there was a real estate-based company in the United States called Zillow. They thought that they built this great technology for purchasing real estate, but it really wasn't that great because, the data that they had was not really what would be faced in the real world. There were more competitive dynamics that the computers didn't understand, and that they ended up making very poor investment decisions and losing a lot of money. So I do think that the machines will need to get better in all of these ways before they can successfully tackle some of these bigger problems.
So Citadel, big banks, apparently everybody aggressively adopting this GPT technology and integrating it in their investing platform.
Look, ChatGPT now in this, at least in the fourth iteration, that can pass a PhD exam, the LSAT, the MCAT, the CFA. It's sort of an 80th percentile. So just by its own, that's a very valuable resource that knows a lot and will be able to present ideas. I would worry more about, again, these inflection points in market, making sure that the data that the computer understands is really the real life market conditions in real life data. And again, I think it'll come down to a combination of combining language models with other types of statistical models to improve that decision making over time. But we will certainly get there.
But knowing how fund managers, human fund managers, form their investment thesis, do the research and do the analysis, make decisions, model, I just can't fathom how the AI can possibly ever be used for anything beyond some repetitive cookie cutter tasks. I guess that relates to what you described as the expense side of the equation. Other than automating those type of tasks, what do you think is their long-term vision here? Are they trying to replace the investment process?
My guess is yes. I think that that there are different applications. To be able to use the machines to improve the productivity of our own analyst teams, so that they can process information even faster and more of it. But ultimately, look, I think people will want to get to a point where this is all, it'll be the new age of systematic based strategies where the computers are in charge of making investment decisions and trade generation, idea generation, and that by itself will create an entirely new industry, because then you will have machines that are trying to predict the machines to get in front of them, and so which could be incredibly exciting, because and again, back to the similarities of my past and the evolution of the options markets and high frequency trading firms, and that this will be a whole new vintage, a whole new generation of all of that.
All right, well, back to realities. All right, so this is now an advice section to retail investors. What are your thoughts on beating the market? One, as a hedge fund manager, and two, as retail investor.
I think it's very difficult to beat the markets over time. I think the data supports that. I think a lot of this comes down to the return stream that you want to be able to create for yourself. Are you doing this to try to accumulate wealth? Are you doing this to try to protect your nest egg for retirement? But I think there's a big difference in trying to produce a 6 volatility, 1 sharp return type of profile, or a 4 vol, 3 sharp, and so that all plays into kind of your own expectations for your own risk tolerance. How comfortable are you in losing money if you have a drawdown? What exactly do you want to achieve from this? But I think it's important to think about that in advance, and then think about the types of strategies that are most likely to allow you to accomplish that. But look, I think it's, just from a head-to-head competition perspective, it's very hard for retail investors who don't, they have a day job, they have their own careers, to be able to compete directly with people who do this professionally, have access to tremendous pools of resources, tremendous pools of data and technology, and are paid to be at the top of their game. If I went out to the soccer pitch and wanted to kind of try to compete with Messi, I don't think I'd have much success. And likewise, if Messi wanted to compete with us, I think he's better off going to great professional managers to manage assets for him.
Well, we're not the Messis, although a lot of retail investors often disillusion themselves for thinking they are. What can we, just average individual investors, what can we learn from professional investors like yourself and other institutional managers?
I think how important it is to have an investment process that you have confidence in, really understanding what your process is, make sure you follow it routinely. And look, a big part of what professionals do is think about risk management. Thinking in advance, where can things go wrong? I would say that the one thing that 26 years in this business has done to me is you become very paranoid over risk management, and that's understandable, because investors they pay us to worry about things, right? And avoid making mistakes. But I would say that the risk management side is something that people can underestimate sometimes, just how critically important that is.
Okay, so risk-adjusted returns,
Yes.
risk management, understanding the risk component, and achieving the returns. Is that maybe what separates a successful fund manager versus a retail investor?
I think in part, I think it's the rigor of the process that they have, the years and time spent doing that to really hone a great subject matter expertise over what you're looking at, and then having great risk management.
All right, so last question coming from the retail investing world, our core audience. Are bonds dead? What should I do with my classic 60-40 portfolio?
Again, I'm kind of looking at my Bloomberg screen right now, but I happen to be in London this morning, which is where I'm at, and there was an important UK CPI print, and I see two-year gilts down 20 basis points in yield. And so, in anytime you have a two-year bond or note, moving 20 or so basis points a day, I think that's a sign that there is still pretty good volatility and pretty good opportunity in the fixed income markets.
All right. Now, lastly, about your book, Fed Up. Before we talk about the book, my personal question, what is your favorite book? And if finance, you can't say Michael Lewis.
Okay, I won't say Michael Lewis, although I would say that I love him as an author and I've read all his materials.
What's your favorite Michael Lewis book, then?
Well, I would say Liar's Poker is probably the one that influenced me the most. But a favorite book is, I would say that Roger Lowenstein wrote a great book called When Genius Failed. It's about the collapse of long-term capital management. That book came out shortly after I started in the hedge fund business. And it was around the crisis in 1998. So to me, it was just... I was still just so young in my career and I was learning so much every day, and to kind of read that book and understand more of the dynamics that were going on at the time was really impactful for me. So it's certainly a book that I would recommend, and I still go back and reread parts of it every so often.
And I guess overall, what inspired you to write this book?
Yeah, look, I would say it was my love of reading. I love to read. I'm an avid reader, and I've always kind of had it on my bucket list that I was going to write a book someday. And coincidentally, the book was written during COVID, as you know, and it covers what was happening in the markets, particularly in the March of 2020, when the markets really sold off because people were understanding just how dangerous this pandemic was. And I was just journaling on markets and kind of commenting to her about, I have amazing content for a book. Like look at what is happening. And my daughter Victoria said to me, "Well, Dad, let's write that book." So it ended up being a great project to work on with her. She ended up being the editor on the book. And for me, it was important because there aren't other examples of a macro professional talking about markets more in the first person, like what Michael Lewis will do. He'll tell a story back in time about events that occurred. But I wanted to tell a story of firsthand how frenetic these periods can be and how much uncertainty there is, and just what that means for an investor's kind of life, their daily existence in periods like this. So it was a really fun project. I'm glad I did it, and I enjoyed working with my daughter on that.
What do you hope the readers take away from the book, especially the average readers, the non-Wall Street audience?
I hope that they gain a passion like I do for markets, because again, I think markets are fascinating. But I also tried to tie in some other things into that book, which was what an extraordinary period of time COVID was. What that meant for some of the more divisive policies we see in the U.S. that I think has driven some of the wealth inequality that's resulted, and the impact that central banks, particularly the Fed, have on that in making monetary policy decisions and adopting policies like QE, like quantitative easing.
Well, now is also a very interesting time in the market, in a very different sense. So can we expect a sequel? And what are you working on right now?
Well, the publishers asked for one. Right now, I'm a bit busy with markets, but I'm certainly taking notes and thinking of new ideas. So if someday you see a sequel, and I mentioned about being on this amazing podcast that was broadcast in South Korea, you'll know where the idea came from.
Okay. All right, everyone. I can tell you this book is a page turner. Lots of real life market events, as well as interesting side stories around the characters. A very good read on how the economy and the central banks interplay with each other. We'll learn a ton about the process and the thought process and the thinking behind a very accomplished macro trader, Colin. So, Colin, thanks again for spending the time to share your insights with us. We look forward to hosting you again.
It's great to spend time with you and keep up all the great work.